One of the biggest risks in retirement today in 2025 that almost nobody is talking about is the sequence of returns risk. Now, when you shift from saving for retirement to living off of your savings, a hidden danger that few people even anticipate or think about is the sequence of your returns, right? And so we're going to look at a $500,000 nest egg and what this would look like and what it could do for your retirement. Now, there's three different main risks here. Number one is the timing challenge. The sequence of returns occurs when you experience poor investment returns in the early years of retirement while also simultaneously withdrawing money from your portfolio. Okay. Now, the idea is that when you're in your working years, market downturns were actually beneficial to you and they were opportunities to buy more shares at lower prices in the stock market. However, in retirement, you're no longer contributing to your retirement accounts anymore. So you're not, essentially buying shares, right? You're not putting more money into your retirement accounts. You are taking money out. So this is exactly how they can become a serious threat to the financial security and your ability to make sure that your retirement assets last as long as you do because in retirement you don't get any do-overs, right? And it really almost becomes like a double whammy. When you sell investments or when you pull money out of the market to fund your retirement expenses, you lock in losses and you're removing assets that would otherwise recover in future upswings. So unlike other retirement risks, sequence risk is particularly dangerous because it strikes when your portfolio is at its largest and also at its most vulnerable. So why the order matters. We're going to consider two retirees here, both starting with $500,000 and both experience the exact same average returns over 25 years. They both withdraw the same amount annually, which is going to be $20,000, which is based on the safe withdrawal rate of 4%. 4% of 500,000 would be about $20,000 a year. And now the only difference between these two retirement accounts here in the green and the red line is the order in which they experience their market returns, right? The retiree who faces poor returns in the early years of retirement can run out of money years earlier than the one who experiences strong returns. And you can see the difference, it's huge. This kind of breaks down the numbers just a little bit more, shows the good sequence versus the poor sequence. With an initial $500,000 portfolio and annual withdrawals of $20,000 not adjusted for inflation, in the good sequence, you can see you would end up with about $1.37 million that remains. Positive returns in the crucial early years create that buffer, right? That helps your portfolio withstand later downturns. After 25 years, you have 1.3 million. In the poor sequence, negative returns in the first few years actually force selling more shares to maintain income, and it permanently damages growth potential. The portfolio is nearly depleted after 25 years with only $310,000 remaining. Right? Now, the real world example here is like the retirement danger zone, we call it. Now, the 5 to 10 years before you retire and after you retire represent your financial danger zone. Once again, considering the two identical $500,000 portfolios that experienced, this is going to show them experiencing the 2008 financial crisis where the market was down almost 39%. Your recovery time to get back to breaking even after you lost 39% would have taken 5 years for accumulation portfolios that were not taking money out. However, if you were distributing and taking income, it could take 13 plus years of recovery time. And some retirees who began withdrawals right after this crisis or maybe right before never fully recovered their portfolio values. So, what can you do? How to protect your $500,000 retirement portfolio? One of the ways is to create a withdrawal buffer, set aside maybe 2 to 3 years of income needs in cash or short term investments to avoid selling during market downturns. Number two, consider guaranteed income sources. Annuities can provide reliable income regardless of market performance, and then you effectively transfer the sequence risk to the annuity company, to the insurance company. That way, you don't have to worry about it anymore. Number three, you could implement dynamic withdrawal strategies, adjust your withdrawal amounts based on portfolio performance. taking less income during down markets to preserve your capital, and then adjusting when the market is doing well. And then lastly, number four, proper diversification. Ensure a balanced low risk retirement or portfolio. Apply the rule of 110 to diversify your $500,000 and to minimize your sequence of returns risk. The right strategy can help ensure that your retirement savings last as long as you do. And if this is something that you want to kind of talk through and make sure that you are in a good position to make sure your retirement assets last, we can schedule a consultation to have that conversation to figure out where you're at and to implement a protection strategy for your portfolio. Disclaimer: this video is not financial advice, not intended for you to buy, sell, or trade securities, but simply as financial education just to make sure that you have the best possible retirement that there is, right? My name's Kyle Demian with the Wealth Academy. Thank you guys for watching. If you got value out of this video, please leave a like and subscribe if you want to learn more about retirement and how to make sure that you live your best retirement.